We're back with our 2011 Outlook with Jon Nadler, the Senior Metals Analyst for Kitco Metals and a speaker at the upcoming Vancouver Cambridge House Show in January. Jon, last time in our previous conversation we talked about China, India, hedge funds. I want to talk to you a little bit about the Fed right now. Will the rising interest rate environment effectively preempt the Fed and attract investment into the dollar and U.S. debt instruments?
Well, it might well do that if, in fact, the trend gains traction and the markets start to vote, in essence, ahead of the Fed. Pretty much the last thing that the Fed expected out of the QE2 was, in fact, a rise in the interest rate environment. And yet that is exactly what 10-year instruments have been showing, certainly over the last month or so. And that is bothering some analysts because they're looking at an environment where the debt instruments and the US dollar will start possibly to attract more investors, and that could temper some of the safe haven quest or the bids that, for instance, gold has received over the last 24 or so months.
Jon, do you think the U.S. economic recovery will prompt the Fed to exit sooner rather than later?
Well, this will be the big question mark, I think, because in essence, it was already anticipated that the economic recovery would get to a level already in 2010, which would have prompted the Fed to begin to enact its exit strategy. This didn't materialize, and of course, we had some up and down numbers in terms of the employment figures, surprises during the year, which then basically convinced the Fed that it was better to enact QE2 than not to. We've also had the European situation, which came into the picture, which certainly delayed exit strategies by other central banks as well. But the Fed, I think, is on course to monitor the employment situation, the GDP situation, and if it sees the conditions as having come about which prompted to commence raising interest rates, as Bernanke recently mentioned, they have no doubt that they can do so. In fact, he made a bit of a joke about it, saying that we could do this in 15 minutes if we wanted to. Well, I don't think it's going to be a 15-minute or perhaps even a 15-month situation, but it certainly could come about if the economic numbers convince the Fed that it's time to act.
And finally, Jon, let's talk about the shifting regulatory environment that seems we're living in right now. Will it alter participation by speculative funds?
It is something to watch for. We've seen a trend since the most recent oil bubble of 2008 towards more regulation, more stringent margin requirements on the exchanges, and when the legislation will come about, I'm not yet sure. At the moment, it seems that the CFTC has been pushed back into January or beyond in order to enact some of the restrictions that were proposed. But when they come about, I think we possibly could see the departure of some funds from the marketplace who feel that unless they can play with wild abandon, they might not want to play at all. But it is a trend, and I think it's an inescapable trend. Our good friend over at RBC, George Giro, mentioned that we should not be surprised, none of us should be surprised if we see the advent of Sarbanes-Oxley type legislations and restrictions coming to the commodities niche. So I would keep an eye on news leaks from Washington in that sector for sure.
Jon, thank you so much for offering your insights on 2011.
It's been my pleasure.
On behalf of everyone here at Kitco News, we wish you a very happy new year. And if you want to hear more of what Jon Nadler has to say, you can catch him at the upcoming Vancouver Cambridge House Show, which runs January 23rd and 24th. You can register at the link below. For Kitco News, I'm Daniela Cambone. Thanks for watching.